My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer America. Other people want to make friends, I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. From far away, this market looks like a beautiful patch of grass. But when you get closer, you realize that this lawn's full of weeds and dead grass and bugs and golf ball. Okay, this is what the market is really about. Not this, but this. See how the averages rallied again today. Dow inching up 47 points, S&P advancing 0.32%, the Nasdaq gaining 1.06%. The precious little Nasdaq over here. But almost 3/5 of the stocks in the S&P 500 are actually down for the year. We're in new high territory because of the other 2/5 that are up a lot. In fact, today's strength was almost entirely from technology stocks. That's pretty incredible. And the lack of breadth here explains a lot more about how the real economy is doing. Here's the real economy. The truth is the weeds are more representative than the healthy patch of lawn. In many ways, it's getting worse, not better, as the weeds begin, I think, to infect the nice part. But when you look at the whole S&P, you can't see the weeds. See, they're obscured by a handful of huge tech companies with big gains. Who wants to talk about the other 291 stocks that are down for the year, when you can focus on the incredible runs in Amazon, Microsoft, Apple, Facebook, Alphabet? It's a lot more fun talking about Tesla, up 378%, than talking about GM or Ford, down 27 and 21% respectively. Tesla's not a small company. It's got about 50,000 employees, but Ford and GM are more important to the economy because they employ many more people, even if their combined market capitalization is now much, much smaller than the fabulous stock that is Tesla. I know I keep harping on this idea that we can't see the damage COVID's doing to the economy because the hurt is so concentrated in small businesses that don't trade. Many smaller retailers simply can't pivot to the web fast enough, and even if they could make that pivot, it still might not even be enough to save them by this point. Now, look, I love Facebook, Etsy, Square, PayPal, and Shopify, all of which are in this gorgeous patch of grass right here, okay? Because they've all gone all in to helping small business go digital. But this is not a problem that can be solved by the free market, no more than the free market alone can beat COVID. Without more stimulus from the government, many of these smaller operators are destined to go under. Unfortunately, more stimulus doesn't anymore seem to be in the cards, and it was so close. The Republicans and Democrats couldn't come up with a deal before Congress went on recess, and I think the faction within the GOP that hates deficit spending will feel emboldened after seeing this week's blowout numbers from Target, Walmart, Lowe's, and Home Depot. They're not focused on whether the economy is going to slump now that the last round of stimulus has run out and back-to-school season is weaker. They're saying enough is enough. And you know what? The last round of stimulus absolutely would have been enough if this were a normal downturn. But there's nothing normal about it. Everything's been turned upside down. You know, there used to be this thing called a lipstick index, which measured consumer spending. Worked great because sales of lipstick would spike as women look for a cheaper way to feel extravagant in a downturn. Good business in a downturn. But who the heck buys lipstick when you need to wear a mask all day? Who'd risk going to a department store to try on lipstick or any other form of makeup in the middle of a pandemic? Not many people, which is why the incredibly well-run Estee Lauder had a tough quarter. We have a bizarre situation where some companies are doing very well, and now you can always remember them through these blades of grass, okay? But a lot of other companies are getting crushed because the staff was able to pick up some. I asked them for some weeds. It's like this place is so well manicured. This is the only weed they can find. So tonight I want to ignore the healthy grass and focus on all the weeds, the stocks in the S&P that aren't working at all. When you focus on the 10 of the worst performers in the S&P 500, well, what do we see? Well, you know, some of it's pretty darn obvious. Remember cruising? Yes, cruise ships, oils, pipelines, retailers, airlines, real estate investment trusts that own office space, and banks. When you think about it, maybe that's not such a big divide between Wall Street and Main Street. After all, Wall Street knows all these industries are in trouble. The real divide is between digitization and everything else. We always get caught up in arguing about whether this is a U-shaped recovery in the economy or a V-shaped recovery or an L-shaped recovery or a W-shaped. Earlier this week, I said we had a fabulous V-shaped recovery in the stock market, but not the economy. Nothing close to that in the economy. That actually made news. After looking at the weeds, though, I think we need to rethink the whole terminology. It's not those letters. No, it's like an entire alphabet of pain. One letter's not enough. See, for instance, if you work or had a job at Norwegian Cruise or Carnival, the two worst performers in the S&P, down 73 and 71%, you aren't feeling a V or a U or even a W-shaped recovery. You're feeling a T economy, straight down after being flat. If you're in Occidental Petroleum, the third worst performer, down 67%, well, you know what you're in? You're in a Y economy, as in why would you be so stupid as to double down and pay a fortune for Anadarko Petroleum right when oil was rolling over? If you own Coty, the beauty brand that's down 66%, or Kohl's down 63%, you're in the M economy, meaning every time you think you're going to go up, you get pushed right back down. And if you work for United Airlines, off 61%, American off 56%, or Delta off 53%, you're in a C economy, bottoming, but you're not going to be able to close that gap anytime soon. Not going to happen. Oh, how about Simon Properties, the biggest owner of mall properties with a stock that's fallen 56%? Well, I call that an X economy. Both lines grounded down because Simon's trying to get out of their deal to double down on Taubman, another mall owner that they decided to acquire before the pandemic. Timing's everything. Finally, there's Wells Fargo, down 56% for the year, where you were hoping and praying we would merely have an L-shaped economy for them, and not something worse. Well, maybe it's a sagging L. Maybe it's someone with really bad handwriting. Once you go through all the decliners, you realize this is a tale of two cities market. It was the best of times. It was the worst of times. It was the spring of hope. It was the winter of despair. We had everything before us. We had nothing before us. The pain from COVID is not totally isolated to small, medium-sized businesses that simply don't trade publicly. There are a lot of larger businesses experiencing their own terrible cycles of pain. The market is full of losers. They're just not big enough to offset the strength of the tech stocks that are making a fortune right now. So what has to happen? Well, it's easy to say, don't worry about it, right? Or one day we'll get a vaccine. In the interim, just let the weeds grow. They're not going to be big enough to take over the whole lawn, right? But, I did feel that way for a long time, but it's beginning to look to me like a mistake. Because while the winners represent more capital, the losers represent a heck of a lot more jobs. And if you want the economy to rebound from recession, those jobs need to be protected. Unemployment in this country is too high. It's too high, period. These 10 underperformers are just examples. There are 281 other losers in the S&P with similar characteristics, and they desperately need more stimulus. In the end, a weed-choked patch of ground signals that the economy is not going to follow that V-shaped recovery that we're seeing in a handful of huge tech names and big box chains. The V-shape that everyone's hoping for. Now, there's some other green here that's not crabgrass. The bull market in housing, that's for real. I'm not taking away from that. Those stocks are all in the new high list, okay? I think stocks like Whirlpool doing really fabulously. That could be a sleeper there for you, okay? I mean, it's kind of like a running back you get in the fifth round that actually gets you a lot of TDs. I'm thinking fantasy. Stanley Black & Decker's real good. You always see Stephanie Link recommend that one. I like Sherwin-Williams and PPG had upside surprise. There's FinTech. I mean, who doesn't love PayPal or Square? But the bottom line, you see, when you get down into the weeds of this market, what you see is that there are a lot more losers than there are winners. That's the nature of the COVID economy. And now that there's no one in Washington willing to play Gardner, maybe it is only a matter of time before the weeds overrun the entire patch.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.